people are too scared that, well, I'm not going to buy now because rates are going to come down. No one's going to do business with them. So what do? They offer these attractive programs to offer small buyouts to people to buy out the loan.
Yeah.
That doesn't happen here.
So true.
It's fucking brutal.
Let's talk about the debt. Obviously, people, when interest rates are all over the place, people get, well, what if rates go up to 10%? Well, we're locked in here, right?
Yeah, so so the style of loan that we're getting currently on the property, we're going with a Fannie Mae product. We're going interest only, and we're doing it for 10 years. And the reason why we're doing it for 10 years is because Fannie Mae offers the best rate at 10 years. Now, you might be thinking like, well, does that mean that you have to hold the property for 10 years? No, and here's why. We can sell at any point in time, okay? The Fannie Mae product has favorable buyout options for the loan. They call them carve-outs or whatever. They're also... It's a very attractive rate. So we're going in at 5.5% interest only. The reason why I'm doing interest only is because you don't really even start paying down principal until you get into the latter part of the amortization. Okay,
that's a good point. Up front, it's almost all interest.
It's almost all interest. So you might as well not even fucking do it. You might as well reap the benefits of the cash flow and have stronger cash flow, especially in a booming market. Okay, especially when cap rates are fairly low in like the 4s. It's going to be tough to cash flow strong, based on a principal and interest loan. So this is a very common thing that large scale investors, and I'm talking large scale investors, even, Grant Cardone and all that stuff, if you see his properties, they're relatively newer. They're in very, populated, booming MSAs. He almost always does on his at least newer shit. They're mostly interest only.
Is this even available in Canada?
No, I haven't seen it.
I don't think I have either. The fact that you can even do that is very interesting, because we don't buy for principal pay down, and we don't buy for appreciation. We buy for cash flow. And then we buy in markets that are likely to appreciate based on
we buy in strong. Exactly, we buy in strong markets. So, so again, going back to why 10 years, the reason the mentality behind this is, even if the rates are, I'm not oblivious to the fact that the rates are probably going to at least come down maybe in 2024, okay? But they're not going to come down to 2-3% again, okay? Even when the rates were at its absolute fucking lowest, I did a deal in Michigan, okay, for Canton Manor, all right? I got a loan when the rates were the fucking lowest, at 3.9%. Lowest. And this is when, again, the rates were the fucking lowest.
Yeah, rock bottom.
So we're getting 5.5% IO. How much lower is that rate going to actually go versus when rates were the lowest in fucking history?
0.5%.
Commercially. Yeah. Exactly. So what's predicted right now coming out of the biggest fucking lenders in the nation over in the US is that you might be seeing rates in and of around maybe like high 4s for the foreseeable future when things stabilize. So are we going to be like 0.5% maybe higher? Maybe, potentially. But as rates come down, the banks are less likely to offer you interest only. Okay, this is a big key here. Okay?
Point.
Exactly. But what happens if rates go up? Now we're looking really good, right? Now we're looking really good, and now someone can either assume our loan that's attractive even if rates come down because it's interest only, okay? Because as rates come down, banks tend to not offer interest only, right? So now somebody really wants to assume that loan based off the fact it's interest only, even if the rate is 0.5 point higher.
Yeah, I can get some cash flow.
Exactly.
Finally.
And then if the rates continue to move, you have a long term in place to keep your product cash flowing very strong, especially if rates start to increase. So no matter what happens, at the point of sale of this property, we're in a good position. And that's also coming from the lender. Again, you can argue that he's biased, but he also wants this to work because he knows I'm coming back to him, especially for a refi position. He knows, again, think about this. Anybody coming to this property, I'm going to have to facilitate, a buyout, right? Or a sale. I'm going to facilitate it. I'm going to bring them to the lender and say, here's a loan, make it happen. He knows at disposition of this property, it's going to have to be a good situation for somebody to come in and buy this property.
Yeah,
he knows, or he's not going to get the referral either.
Pretty simple.
So at the end of the day, he's putting us in and he's coaching us on what to do that is optimal at the sale, no matter what the economy is doing. So it doesn't matter if the economy is coming down with rates, or the lenders are coming down with rates, or they're going up with rates. Regardless, it's a 5.5%, and it might even be a little bit lower when we actually lock in the rate. At 5.5%, that's a favorable rate. And then regardless if it goes up or down, because it can't go down much lower. It's probably not going to go down much lower.
True.
So,
and if it does, let's say it ticks down 0.5% or so.
Even a full.
Yeah. Let's say it ticks down a full. Well, the value of the building just went up.
Exactly.
Right? Because the debt's 100%. Cheaper. I can pay more for the building. Multifamily goes up in price.
Yeah.
If the rates go up, okay, well, now I got a interest-only loan that's producing cash flow. So it's almost like a win-win situation, regardless of 100%. How it shakes out.
Yeah, worst case scenario, at the point of sale, we're going to be a 1%. Say for example, the rates come down significantly. Okay, remember I was talking about a favorable buyout strategy, right? Say the rates come down, 1% or whatever. We get a buyer that wants to come in, put his own debt on it. It's 1%. 1% fee. That's fuck all. You kidding me?
1% to you or to them?
No, it'll cost us 1% to cash out of the loan.
Cash out of the loan.
Exactly, right?
Yeah.
So you're talking about like $30,000.
So that's actually way lower.
You're talking about a couple $100,000.
Yeah.
But even if you're talking about like the loan is going to be about like $3.5 million. $3.5 million? Yeah, about $3.5 million. No, you're actually $30,000. $35,000. 1%.
Way cheaper than I thought it would be.
Exactly.
Yeah.
So the U.S., and here's another thing about the U.S. The U.S. has favorable programs like that in place because they know that the rates, in the event that they do come down, they don't want people getting all fucking crazy, right? They want to offer strategic options to buyers now to want to buy.
So true.
Okay?
Man.
Because
they're not going to get any business.
Exactly. Because if people are too scared that, well, I'm not going to buy now because rates are going to come down, no one's going to do business with them. So what do? They offer these attractive programs to offer small buyouts to people to buy out the loan.
Yeah.
That doesn't happen here.
So true.
It's fucking brutal.
Now, let's say this same deal was here and you go to the bank and say, okay, what's the debt going to cost me? And then you run your numbers and it's like, well, there's no cash flow here.
Exactly.
On to the next. You don't buy it.
Exactly.
You just don't buy it. So, yeah, that's huge. That's why we love the U.S.
Exactly.